Hello everyone, hope you're doing well. Welcome back to the Road to Retiring channel. Today I want to speak about NMI Holdings. Now this is a stock on my metric meters sheet, as you can see here, and this tab right here, the metric meters, are the stocks I want to own if their buy prices, or if their market prices, fall below my buy price, which as you can see here has happened and is currently a 0.97% upside to my buy price. And I don't actually currently own this, so I might be adding some. As you can see, the last time we reviewed this was the 8th of February. So I'm going to go over it again now and just check that this buy price is still something I agree with. And let's go into that. So to start off, why do I like the company so much? Well, as I say, the metrics are really good. If you look at this income statement here, you can see annually the profit margin, which is the line in gold, you can see is growing really nicely from 2020, up from 39.6% to a 55.97% profit margin. Really impressive profit margins. And as you can see, there's been this big drop in the price since like 6th, 7th, 8th of March because of the whole financial industry is struggling at the moment due to what happened to Silicon Valley Bank. But this isn't a bank, this is a mortgage insurance company. And yeah, as I say, there's been a big drop since the whole financial industry's been taking a hit, currently down around 10%. So I'm gonna go into it now and show you why I love the financials so much. The earnings, first of all, just super amazing growth from 2015 to 2022, and as you can see, the forecast for the future is also just as pleasing, including the sales as well for revenue. Incredible growth from 53 million in 2015 to 475 million in 2022. Super impressive growth. And it's not just EPS and revenue. You know, the other two things I like to look at are operating cash flow. So let's get into that. Statements, cash flow, operating cash flow, the cash from operating activities here. You can see up from 71 million in 2016 all the way to 313 million in 2022. Now you might notice this slight dip from 2021. If we look at it in more detail, you can see that the funds from operations in 2022 actually are up considerably from 2021. It was just this change in working capital, which was minus 97 million in 2022, which has caused the cash from operating activities to fall. And this isn't something which happens every quarter. As you can see, it was just quarter 4 of 2022, minus 71 million in change in working capital. Now the change in working capital is a lot more sporadic, and it's really nice to see that funds from operations increasing in this way. And lastly, I like to look at the growth of equity. I want to see the total equity growing. And let's get rid of funds from operations from this graph. If we put total equity into it, you can see growing really nicely again annually from 475 million in 2016 to 1.61 billion in 2022. And their assets are so comfortably over their liabilities. It's really good to see. They have 2.56 billion in assets compared to just 947 million in total liabilities. So their assets are covering their liabilities with plenty to spare. So that's really good to see. So fantastic across all 4 of those metrics that I like to see. They have a history of growing. So that's the first pleasing thing. The second thing I like to look at is what sort of financial trouble could they be in terms of debt. And if we look at their total non-current liabilities and their long-term debt, you can see they have 400 million in long-term debt. And their cash flow currently is sitting around 300 million in free cash flow. And I like to see that a company can pay off their long-term debt within 3 years of their free cash flow. And they've got plenty of room to do that. They can pay it off over 2 times with their free cash flow. So I feel, again, comfortable with the debt that they have. I don't think they're taking on too much. And lastly, what I like to look at, I want to see that the management is making effective decisions. So if we hop over the statistics, their return on invested capital is showing good signs to me. You can see quarter on quarter, this is growing nicely. And if we look annually, I like to see roughly above the 10% benchmark for return on invested capital. And since 2018, this has been around 14-15%, 14.4, 17.8, 12, 12.4, and back to 14.71 currently. Now this is nicely above that 10% benchmark I look for, and I'm confident the management's making effective decisions. And so because it met all 3 of these things that I like to have a look at and see that a company is performing to, I thought this is a company I want to own. I think it has really good financials. So I want to go into a bit more detail on the valuation of it and at what price I should buy. So I head over to my stock valuation sheet, and again you can see here the return on invested capital was good, the 3 times free cash flow was good, and these growth rates fantastic at around 20%, 30%, and just infinite because the APS was negative in 2015. Going over the value, we have a look at it. You can see the analyst 5-year estimate is 14.54%, and the realistic growth rate is 13.68%, so it's not too different, and it very much could grow at that 13% mark. I'm going to be a little bit on the safe side and go for a 10.5% earnings growth in our estimate, which is halfway between the half analyst growth rate and the realistic growth rate, just to be a little bit more cautious and on the safe side, as analysts do tend to be a bit too optimistic sometimes. Additionally, there is no dividend with this, so we've gone for the 9.5% discount rate, and the margin of safety, we've kept it low as it has that really great historic performance. Lastly, I've gone for 2% share dilution. Now, they have actually started buying back shares, so hopefully we don't see 2% share dilution. If you look here, we get rid of return on invested capital, move to total common shares outstanding, you can see they did dilute quite a lot in 2016 until 2020, going from 59 million shares up to 85.16 million. But this has started to fall. They've been buying back shares since 2020, and they currently have 83.55 million total common shares outstanding. So hopefully, because of this means that the share dilution won't be at these 2% levels, and if we were to change that, it would impact our value and make it an even better price. But I'm going to keep it at 2% to be on the safe side. With this 10.5% earnings growth, I put in the EPS estimate, and this is supposed to say 2023. I put in the EPS estimate for 2023, and the price over earnings multiple. Now I've gone for 8 for the price over earnings multiple. If we look at their valuations, you can see the sector median or the price over earnings sits at 9.98. So I think this is nice and conservative, and the 5-year average for NMIH is 12.13. So I think 8 is really conservative and on the safe side. And if we look at their price over earnings ratio over time, and let's just move it to here so it's a bit clearer to see, you can see right now it's at 6.5, 6, but it was, as I say, as high as 11 just a year ago, and it was even as high as 20 historically to that. So I feel comfortable around that sector median. Below it even, we're going at 8, the sector median's at 10, and the 5-year average is at 12.13. So I think 8's a nice bit of taken off that to still be in that comfortable range, and that gives us a fair value and 2028 price of $23.89 to buy under based on the price over earnings, and a 2028 price of $41.78. So that would be a really nice return. And if this share dilution didn't happen, if this were to be 0%, then that jumps all the way up to $26.37 as a fair value, which I think is really appealing. I'm going to keep that 2% there though, but I just wanted to show you if that doesn't happen, then we have a really good potential buy opportunity here. Now, in terms of the price to sales fair value, I've gone for 10% revenue growth. Now this is in line with, as you look at the earnings here and the earnings estimates, you can see revenues expected to be 560 million in 2023, up to 620 million in 2024. So based on this, I put these values in at 560 million, growing to just under that 620 million in 2024 at a 10% revenue growth rate. I've gone for a price to sales multiple of 3.5. Again, this is based on sort of the current metrics. Right now it's at 3.65. It was at 3.4, 2.8. But historically, it always seems to trade between maybe 5 and 2. So I thought 3.5 is a pretty reasonable median to see that price to sales ratio trading at. And as you can see for NMIH, if we go to the valuation, their price to sales currently at 3.6 and their 5-year average is at 4.3. So I think 3.5, cutting it under that by a little bit to be on the safe side, I think that's reasonable. And based on these estimates of a 10% revenue growth, that gives us a fair value based on the price to sales of $19.47. Now obviously this is still under current price. It would need to fall an additional 10% for it to be worth that based on the price to sales, and a 2028 price of $34.06. So still some really nice growth there from the current levels at $21.62, but we would like to see it drop a bit more before it falls to our fair value based on the price over sales. And lastly, looking at the price over operating cash flow fair value. Now again, I've showed you what the estimates for operating cash flow are for 2023, and I've used that funds from operations value rather than taking into account the change in working capital. Again, I've used things based on the sector. So the cash flow, their current cash flow is at 5.92, sector median's at 6.5, and their 5-year average is at 8.04. I felt 6 was reasonable as a price to cash flow multiple. And additionally to this, I've gone for that 8% growth, keeping their operational cash flow a little bit above their net income in 2028, net income being 484. We take into account things like depreciation and change in working capital, things like this, and I think that's reasonable to expect just over 100 more in 2028 for operational cash flow compared to net income. And that gives us a fair value based on the cash flow of $21.74 with a 2028 price of $38.02. Now, taking all of these together and getting an average, this brings our fair value to $21.70 with an average 2028 price of 37.95. And if it does hit that value in 2028, then that would be an 11.91% return on our investment each year. So I think it's really interesting at these levels, and if I am now to change that share dilution again, if they do buy back some shares, then let's say it's -1%. If they buy back shares, then bang, it's a 15.3% potential compound annual growth rate annually. So I think that's really something which could be interesting, and I think I might be adding some national mortgage insurance to my portfolio. Let me know if this is a stock you're interested in or if you've heard of this before. And yeah, it's been Road to Retiring. Appreciate you guys watching. Please like the video and subscribe, and let me know in the comments any other stocks that you'd like to see me value and cover. But for now, I'll catch you in the next one. Bye guys.